No amount of sophistication is going to allay the fact that all your knowledge is about the past and all your decisions are about the future. These are the famous lines of legendary investor Howard Marks, and in this video, I try to explain 6 insights that have helped him frame his investment philosophy. Two things clearly stand out: being different and being right. Let me quickly jump into the insights now. Market participants view the market activity through the lens of boom and bust cycles and anticipate future movements based on past performance. In general, market cycles are nothing but an up and down oscillation around the central median line, and these traditional terms create a distortive effect. So one should gently avoid them and look at markets more productively, like excesses and corrections. Insight number two: the importance of intellectual humility is being aware that there are limits to knowledge. The current global health crisis is a clear case in point. Since there is no precedent or a recent parallel, the conventional assumption that this is an asset bubble or a debt crisis is of absolute no use or of little use. Therefore, it is silly of an investor to build his investment conclusion on how this disease will pan out when he absolutely has zero knowledge about it. Insight number three is all about insisting on margin of safety. A smart value investor always looks for margin of safety in the underlying securities. Therefore, when you make a judgment, you need to understand the current price relative to the underlying fundamentals. To do so, the investors need to check the company and also the stability of the industry and understand both in detail in response to the price that it is currently quoting. Therefore, insist on margin of safety. Insight number four. This is my favorite. Know when to get aggressive. Great investors tend to be circumspect about their investments. That's the concession they give while dealing with what they don't know, and therefore, for investors, caution is the best strategy while dealing with the unknown. But these very same great investors go on an aggressive mode the moment they find something very good. Toggling between aggressiveness and defensiveness is the greatest single thing the investor can do if done appropriately. Fifth important insight is be different but be right. Following the market has never led to outperformance, and I'm sure you've heard it many times. If you wish to generate superior performance, try to stay away from the herd and be right. The strategy may sound very simple, but believe me, it is very, very difficult in practice. Reacting negatively to consensus is a easy job, but in investing, the consensus or the markets are generally more often right than not. Therefore, knee jerk contrarianism is certainly not a successful strategy. Weighing all the factors, all the important decisions before going contra. The sixth insight is a psychological one: get comfortable with discomfort. Every great investment starts in discomfort. If everyone around you doesn't hate the asset, will it be cheap? No, right? An asset is cheap because nobody wants to buy them. An asset with the highest margin of safety or the largest gap between the current selling price and its intrinsic value is the most unwanted, and holding an unwanted asset is not comfortable. The bigger issue is holding on to an uncomfortable asset for a longer period of time. It's a test of your time because you may end up holding this for months or maybe years. Yet, the investment decision that you make today will never get validated the very same day. It can last for a long time. Currently, the world is struggling with the global pandemic and its financial crisis. So, we believe that this uncomfortness will be a part of the financial markets for the foreseeable future. The pandemic and its economic impact can last for a long time, and hence get ready to be uncomfortable. Thank you for watching this video. Hope you liked it. Please do subscribe and do share feedbacks. Good day.